Now we are moving into a very crucial topic known as lot size. This is the reason why most people blow accounts, because they don't understand the meaning of lot size. This happened to me in my early days of trading as well. And anytime I forget to consider the lot size, I always face the music. So I will try my best to explain this concept. So lot size is the amount or quantity of a trade that you buy or sell. You can see the word quantity. I can have something like this. I have something like this. And I have something like this. Inside here, I can have 10. Inside here, I can have 5. Inside here, I can have 2. So this big one is represented as the standard. This is the mini, and the micro is this. This is the concept of lot size. Alright, in the forex market, the currencies are not bought and sold as a single entity or whatever it is. They are bought and sold in packs called lot sizes. In packs, in the sense that this is one circle, but inside this circle we have more than one item inside there. And this is another circle, and inside we have more than one item, though it is smaller than the first one. And this is another circle, we have more than one item here, and it's also smaller than this one. So they are all 3 circles, but within them are items of different sizes or packs. So that is what makes the gain appreciable. If not, your profit in forex would have been this, or very minimal. But because you can decide to buy currencies in bulk, like if this were to be euro, this is 10 of it, not just one. So let's just go ahead and explain this to your understanding. So lot is simply a measure of volume. The standard lot has 100,000 units. For example, if I have Euro USD, and then whenever I want to place a trade, I have to choose my lot size. Let me show you what I mean. This is the trading app, and if I want to place a trade, I'll press a F9 on my keyboard. Then you see this volume here. This is what we are talking about. When I drop it down, standard lot means 1.00. That is the standard lot we are talking about. And you can see it has 100,000 of the base currency. The base currency here is euro. Remember the base and quote currency class? We said the base currency is the first one. So when I choose a standard lot, I'm going to have 100,000 of the base currency. That is what I'm trading with. Now let's go to the second one, which is the mini, which is the the mini lot, and that is 0.1. When I'm trading with this, it means I'm buying 10,000 of euro, which is the base currency. And when I go to the last one, which is 0.01, it means I'm buying 1,000 units of the base currency. So this is what we mean by those things we have here. So from that, we saw that standard lot is 0.00. So whenever I want to place a trade and I choose a volume of 1.00, it means I'm buying 100,000 worth of whatever currency pair I'm trading. If it's Euro USD, that means I'm buying 100,000 worth of units of the base currency, which is euro. If I go with mini, it means I have to choose this 0.10, and that means I'm buying 10,000 units of euro. And if I go with micro, it's going to be 0.01. It means I'm buying micro. Now, not all brokers have this nano. This is so little and is sometimes can be very, very small. I remember I saw this on one broker at a time. Not all brokers will allow you to buy nano. This is the list offered by most brokers, but I've seen this somewhere, somehow. And when you choose this, you're buying just 100 units of euro. Now, remember that some brokers allow you to deposit $10. So how can you use $10 to buy 100,000 units of this currency? We shall get there. That is what we call leverage. Your broker, they borrow you money to trade the forex market. We shall get to that place. But I understand, I hope you understand what we mean by lot size and how it appears in real life. Alright. So this is just kind of revision. Now there's something you have to know. When you use a standard lot, this is a standard lot 1.0, and you're buying 100,000 units of the base currency, each movement or each pip, which is one movement on the chart, is equivalent to $10. For example, if Euro USD moves from 1.3230 up to 1.3231, how many pips is this movement? Is 1 pip. So what it means that if you're trading a standard lot size, each movement on the chart is going to cost $10, either positive or negative, or either in your direction or against you. That is what it means, because this is a standard lot size for trading. If you're trading a mini lot size, which is this, which is a $10,000 worth of euro, each pip is going to worth $1. And if you're trading the micro lot size, which gives you 1,000 units of euro, each movement, each pip is going to cost this. So this is where most people get confused, and this is where most people blow their account. Now, if you have a $10 account, you can never trade a standard lot. You can never, because just a simple move against you, in fact, it's not possible. The system will not allow you to trade that. But let's say it will be possible. Just a single move in the opposite direction, your account is blown. Then if you have $10 here as well, and you're trading the mini, if you have $10 and you're trading the mini lot size, some broker will not allow you to place that trade, because 10 pips against you, your account is blown. But if you have $10 and you're trading micro lot size, $10 against you will be minus $1. Yeah, that is how it is. 10 pips against you, against the direction. Let's say what I mean against is this: maybe you speculated and you analyzed that the market was going to go up and you entered here, but instead the market went against you. It went 10 pips against you. Here you're going to lose $1 out of your $10 account for micro. But if you're on mini, if you use a mini lot, if it goes 10 pips against you, that means your $10 is gone. And if you're on standard, just 1 pip against you, your $10 is gone. So try to understand the concept of this lot size, because it's going to make you determine who you are in the forex market. So here is a brief table of what you can do with 15 pips. From these explanations here, this one here, this lot size here, falls under this category, which is a mini lot size. If you move 10 pips on mini lot size, it's going to give you $15. Then if you move 0.5 lot size, it's going to give you that same 15 pips, is going to give you $75. Then if you make it one standard lot, it's going to give you 15 pips, it's going to give you $150. Then if it's 2 standard lots, that is $300, and 5 standard lots, that is $750. Because I want to explain this thing to you in full. The minimum is 0.01. You can as well go up like this, 0.2, 0.3, until you get to 0.09. And after 0.09, the next is going to be 0.10. That means you have now entered the mini lot size. You start from micro 0.1 to 0.9. Then when you get here, you enter the mini. Then the mini runs like this: 0.11, 0.12, till you get to 0.99. Quite a lot in between this and this. This is 12. We have 14, 20, 35. Then when you arrive at 99, let me make this very clear. This is where the mini lot size ends, and after that, the next thing is going to be standard lot. And trust me, Trust me, you can't exhaust this, because you're going to have 2 standard lots, 3, 4, 10 standard lot, 50 standard lot, 100 standard lot. No, that is huge. So I hope I've been able to break down this lot size based on the packs as explained. Let's move ahead. Okay, still on the lot size, we've talked about standard. One standard lot means 100 units of euro. In this case, this is the base currency. One standard lot means 100,000 units of euro, and such as any other pair attached is 100,000 of such currency. So this is straightforward. That is for standard lot, which is 1.0. Then for mini lot is 0.10. So 1 mini lot of this means 10,000 units of euro, and also 10,000 units of any base currency associated here. And the micro lot size, which is 0.01. So 1 micro lot of euro USD is 1,000 units of euro, or any other base currency associated with the currency pair. So that is just. Now let's see something very, very interesting here. Remember what we said about ask price? Let me go back to the chart. Should you open any trading platform and you see ask price at this level, what it means is that when you buy using one standard lot, remember standard lot is 100,000 of base currency euro. So what it means is that when you click say buy and you choose 1.00 as your volume, or here is a standard lot, it means what you're buying is the price multiplied by the units. I don't know if you get this. Let's start again. One lot is 100,000 units of euro, and you come into your trading app, you saw that euro USD is at this price and you want to buy. When you place a buy using standard lot, this is how much you're using at that particular time. Despite having a $500 account, this is what is actually going on. This is what you're using to enter into the market. But your equity is lower than this amount. So where do you get this amount? This $113,000. Your broker is the one providing it. Your broker lends you money to trade. As soon as you open the trade, they give you the money. When you close, they take their money away. So if you were to buy using a mini lot size, this is the unit of euro you're going to be buying, 10,000, and when you multiply it by the price, you are using $11,000 to go into the market. And if you use a micro lot size, you're buying a unit of 1,000, you're going into the market with $1,132. So this is what we call leverage. Your broker lends you money whenever you want to trade. And this is why individuals were not able to trade the forex market until the brokers came in to help individuals. by giving individuals money to help them have a huge amount which can be used to trade the forex market. So here it says, how do you get amount of money to trade huge lots? Your broker has you covered. This is where your broker come in to help you trade the forex. So without your brokers, trading the forex will be difficult. So who is a forex broker? Intermediary between you and interbank system. Now, interbank system is a network of banks that trade with each other. Like we saw before, banks trade the foreign forex market. Companies trade the forex market. Even countries trade against countries in the forex market. That's why I told you that forex will never end. It's only business that will never end as long as humans still exist on this earth. So a forex broker is a financial service company, almost like a bank, provide trader access to platform for buying and selling of foreign currencies, for buying and selling forex. Your broker provide access to a platform for buying and selling currency pairs. So here I have a platform that I use for buying and selling. It was provided by my broker. So without the brokers, I as an individual will not be able to trade the forex market. So a broker may also be known as a retail forex broker or a currency trading broker. So we have brokers that are regulated and those that are not regulated. National Futures Association can help you find out more about a broker before you go on to do business or deposit your money with such a broker. But in case you can't find out yourself, I've done that and I'll continue to do that. My job is to find reliable brokers, and I will always tell you or put a link of those brokers somewhere in the description where you can see them, so you can easily sign up with them and you make sure that your money is safe with them. There are some brokers that can even take 10 minutes if you want to withdraw. In 10 minutes time, your money is in your bank account. While some brokers might take 2 to 3 working days to send your money to your bank account, some brokers will take less than 10 minutes, 30 minutes to do that. All this I will be explaining, and I'll put them somewhere where you can see them. So when choosing a broker to work with, check first to know or ask whether a US authority regulates them. When they regulate them, they watch whatever they do. They can't run away with your money. So when a broker is regulated, they will disclose this information, as in the broker will display the information about their regulation on their websites, so that you get to know more. So here comes the leverage we are talking about. When you register, or when you are trying to register on your broker website, sometimes your broker may ask you to choose your leverage. You can have 1 to 50. Some start from 1 to 10. Doesn't matter. These things are not static. Some have 1 to 100. Some have 1 to 200, 500. Some have 1 to 1000. So the higher the leverage, the more buying power you will have. So you can see that leverage is offered by brokers to maximize traders' buying power by giving them the ability to deposit a small amount of fund, such as $10, and trade large volume, such as $1,000. Leverage in forex trading is all about entering borrowed capital into transaction. The money you borrow from your broker is what you use for the transaction. So the money is borrowed from a broker who acts like a bank that fronts you some cash to invest. So leveraging helps one to trade a large deal, hence amplifying their potential profit and loss. When you use leverage, you trade, your buying power is multiplied. And also when you lose, your losses are multiplied. So that is one thing you have to know about leverage. It has the good side and the bad side. Whatever you do, it multiplies it. If you win, it can multiply it. If you lose, it can also multiply it. So now here, let's see a particular example using two specific this leverage A is 1 to 20. Then this is for A. Then leverage B is 1 to 200. Let's see how it can help you to make profits or loss. This first person has leverage of 1 to 20 and this second person leverage of 1 to 200. And both of them invested $100. They invested the same amount. That of A is 20, so your investment is going to multiply by 20, which gives 2,000. And that of B is 200, so it's going to be multiplied by the investment, which is 20,000. So as soon as you enter the market, this is the amount that you're going to watch or you're going to use to trade. Then if you make such as 30 pips, I believe you now understand this. This is 30 pips. Trader A, because of this 1 to 20 leverage, Trader A will be making a profit of $6. While Trader B, because of this leverage of 1 to 200, will be making a profit of $60. So when they close the trade both at the same time, Trader A is going to have a balance of 106, while Trader B is going to have a balance of 160. So you can see, despite having the same investment but different leverage, the trader with the higher leverage is tend to have more. And also, if you were to be a losing trade, the trader with the higher leverage is going to lose more. So this is what it is. So you have to be careful while choosing leverage. So sometimes as a beginner, 1 to 50 or 1 to 100 would be okay as a beginner. Just use a leverage of 1 to 50 or 1 to 100. Then as you advance into trading, understanding everything, you can now adjust your leverage according to what you understand or according to your own method of trading. So this is what leverage is. We have trading times and section. We have Sydney, Tokyo, London, New York. These names are gotten from the countries. Like example, London section is United Kingdom, Sydney, Australia, and Tokyo, Asian region. And New York is for the Americas. So what it means that the banks in those countries open at a specific time and close at a specific time. For example, most banks open 8 a.m. their local time and close 4 p.m. their local time. That is about 8 hours of 8 hours of work period. And when you check each trading section, it's about 8 or 9 hours. So section mean the time the banks in different countries open for business. So you can have different sections for different countries. This is for Nigerian zone. We also have for other zones. So if you live in, especially in Africa, you will see that most banks open by 8 and they close by around 4. This is 1, 2, 3, 4 or 5. So most Africans trade this section. Now there's something you have to know. This is the London section. The London section is on and the New York section opens. So between this period, we have two sections open at the same time. This is a good time to trade because the market is volatile. Transactions are going on, the market is moving, the charts will also expected to move. So when section overlap, that is a very good time to trade. So the same way, best time to trade if you're in Africa or Nigeria is between 8 a.m. and 5 p.m. Now, forex market analysis. Before we click sell or buy or do anything in the market, we have to analyze the market using these 3 basic analysis: technical, fundamental, sentimental. Fundamental means something like GDP, interest rate, non-farm payroll, like how many jobs are created. These are economic news which has a calendar so that we can check when such news is going to be released. For example, here is example of an economic calendar. Here we're going to check the news and the time is going to be released. So here we have a high impact news, medium impact news, and low impact news. I'm going to dedicate one single video on this. So what it means that once these news are released at the given time, the forex market tends to adjust depend on the outcome of the news. So the fundamental analysis is using the outcome of the news to trade the forex market. Like this non-farm payroll is one news that comes out every first Friday of every month. Traders wait for that time because the market moves a great deal during the time the news is released. So what they do, they will wait and see the outcome of the market. If the market is good for the currency they want to trade, they either buy or sell. It doesn't matter, but they have to wait for the news to be released. Then whatever is the outcome of the news, for example, if the news is good, that means that currency is strong. Then if the news is bad, then they will take action based on the outcome of the forecast and the actual. So that is what you have to know about fundamental. It means trading the forex market using the news. So the next one is the technical analysis. This is where most traders fall in because the news don't come out every day and every time. So if you're using things like trend line, indicators such as moving average, stochastic, RSI, ATX, whatever indicators you're using, if that's what you use to trade, you are a technical trader. If you use support and resistance, anytime you analyze the market using the chart, you are basically doing technical analysis. So in technical analysis, you are dealing with indicators, support, resistance, candlestick pattern, Fibonacci ratios, RSI, stochastic, and more. These are all indicators. So this is basically when you see traders plot on their chart. They are usually what we call technical analysts. So, to share with you an example, there's a chart in the next slide which has a 200 period moving average and a black line with support and resistance. You need to know everything from A to Z. You don't have to know everything like fundamental, technical, or sentimental, but rather pick that few tools that resonate the most with you and be profitable from it. You have to choose which one you want to specialize in. But if you can specialize in all of them, it's still good for you. In this chart, here is a resistance line, and here is a support line. Here is a moving average. So if you are that trader that mark your chart this way, then you are not using fundamental, but you're using technical to analyze the market. That is what it means. It's not something that is very serious. Then the last of them, which is the sentimental analyst, what they do is that they collect data from individuals who are already into the trade. So this is a widely popular form of analysis. So when you try to see what other traders are doing, the currency pair they are trading, for example, euro, you want to trade euro USD, then you log into a site that tracks the activity of most traders and see how many percent of those traders are long and how many percentage of those traders are shorting that pair. There you will make your choice on which one to go with. So let's assume that overwhelming number of traders and investors are bullish in the euro. They are buying the euro. They think the euro is going higher. So when people vote with their trades, you can access through some sites such as Daily FX. Euro USD sentiment show most traders are buyers in the currency pair. So this is using what people are doing to be the basis of your own analysis. Let's say a trade is going 70% are buying, 30% are selling. You can decide to go with 70%, thereby by buying that market. When you do that, you are using sentimental analysis. Okay, here, does Forex trade on weekends? No. Forex market stops on Friday around 11 p.m. and they open on Sunday around the same time, 11 p.m. So the Forex market closes on Friday night, could be 10, 11, in this case UK time, and does not open again until 9 p.m. UK time on Sunday evening. But there's something you have to know. This market is only closed for retail traders, not for central bank and related organizations. So the big boys are not out of the market. It's we, the retail traders, that are out of the market. So the Forex trading actually does takes place over the weekend. So this means that there can be a difference in price between Friday close and Sunday open. That is usually known as a gap. So you can see that though the brokers made individuals like me and you to partake in the business of Forex trading, but we have some limitations. We are not allowed to partake on weekends, but the big boys are always there. to take part in the trade. Thank you for watching that awesome introduction of Forex. Most people prefer to buy beer for you instead of showing you how to make that millions of money. I'll see you on the next one.